Hi folks, Chuck Gibson from Financial Perspectives with December 2018's Charts on the Move. What a difference a quarter makes. We went from making all-time highs at the beginning of the quarter to one of the worst quarterly stock performances in the history of the markets. Before I get into this month's video, I have a few changes I wanted to let listeners know about. Going forward, starting with this month, I'm only going to produce a Charts on the Move video once a quarter. As trend followers, most of the time the markets don't change from month to month, at least enough to warrant an update other than to say, it's more of the same. Instead, I plan on producing more, shorter length videos, either highlighting notable opportunities, major changes, or whenever something occurs and presents itself as a teachable moment. Those will occur not on a regular basis, but rather whenever they develop. That being said, and wanting to start the new format, instead of this month's video being a market review, I'm going to cover the most important topic facing all investors, risk management. Let's jump right into it. When defining risk as a loss of investment capital, there's no question individual stocks present a much greater risk than indexes or baskets of stocks. Not so much the potential for a loss, as all stocks have the potential to lose, but rather the size of the loss. Indexes and baskets of stocks, because of their built-in diversification, have a lower potential for a large loss. But what both investments share in common is the fact that they take the stairs on the way up and elevator on the way down, making the case of why you need a management plan for either before you buy. To illustrate this, let's take a look at a couple of individual stock examples. The first is a 6+ year look at Spectrum Brands, symbol SPB, ending in May of 2017. It's clear the stock is in an uptrend, making higher highs and higher lows, and staying above its rising trend line. This is the hallmark look of an uptrend, and unfortunately, all uptrends eventually end. Fast forward to bring the chart up to date, you can see that the stock has broken its uptrend line, began to make lower highs and lower lows, and is massively oversold with the bottom nowhere in sight. If you are an owner of this stock, you've lost more than 70% from peak to trough. By holding and subjecting yourself to that loss, you would have to earn more than 350% just to break even. It's safe to say that 350% returns don't come around very often and take a very long time, such as years or decades, to materialize. The next stock is Cormark Holdings, symbol CORE. The first chart is a stock of February to November of this year. Like SPB, the stock was in an uptrend, above its rising trend line and making higher highs and higher lows. You can see the stock broke out from this nice base back in June and rallied more than 75% in 2 short months. It peaked, began consolidating, building a new base, and eventually broke out to new all-time highs, setting itself up for another big run. Bringing this chart up to date, price has broken down and retraced almost the entire way back to the initial breakout buy point, falling 42% in 37 days. Like SPB, it's massively oversold, and both are ripe for a counter-trend bounce. Those that held on are going to have to find another investment that will return 70% just to get back to even with those investment dollars that were committed into Cormark. My last example is an index fund, the U.S. Small Cap Broad Market, IWM. This 2-year look that ends in September of this year shows the stock above a rising uptrend line, making higher highs and higher lows. In August, it broke out of this ascending triangle pattern here, and it started its run, which, based upon the pattern's target, was much higher. Bringing the chart up to date, you know what comes next, just not how much. The index broke its uptrend line, began to consolidate, and then got the rug pulled out from under it. It's fallen 27% and has now changed character as it's making lower highs and lower lows, the hallmark of a downtrend. While 27% is not fun, it's a far cry from my individual stock loss examples of more than 40 and 70%, illustrating my point about the lower inherent risk in indexes and baskets of stocks. You may be wondering if I cherry-picked these specific examples to make my point, and the answer to that question is no. They're good representations of what the market does and is doing when changing character from uptrends to downtrends, or sometimes referred to as from bulls to bear markets. There will be hundreds of examples that will show much better and much worse returns than the above examples, which points out to the randomness of the market. It goes without saying, if we knew which ones are going to fall the most, we'd avoid them. Even better yet, if we knew when the market would reverse course to the downside, we'd avoid them all. But we don't. No one does. So what's an investor to do? Buy and hold and have your investment account get pummeled when the market changes, or have a plan and exit based upon that plan, thereby limiting losses. What you do is up to you. It should be no surprise I prefer a plan. But even if you do have a plan, there's still risk. There is no panacea in investing. No plan's going to be correct 100% of the time. In fact, most of the best investors' game plans I know have them losing money more than 50% of the time. Let me let that sink in. I did say they're wrong more often than they're right. But if your goal is to make money, being wrong more than you're right requires that you don't stay wrong and minimize those losses. Even when we follow our plan and quickly move to exit losing positions, the market has a nasty way of immediately reversing course to the upside. Because of Murphy's Law, that will likely occur the day after you exit. The key point here is that you don't lose money by exiting, you just don't make it. That's the risk. As humans, we have an interesting set of emotional drivers. It's been shown the average investor is okay with losing money, even large losses, as long as his peers are losing similarly. On the flip side, if the investor is making money, but at a slower rate than his peers, this creates a negative emotional response. Both of these responses seem counterintuitive, but money elicits powerful and sometimes strange emotional responses. With all this in mind, as an investor, you have to ask yourself if you prefer to subject yourself to potential large losses. And the older we are, the less we should be willing to do that, unless you have more money than good sense, or the chance of missing out on potential gains. Once this question is answered, it leads to the final step of how you manage your investments to meet those goals and desires. If we have entered an extended bear market, it will be the first one in more than 10 years, and because they're so infrequent, I find there's huge value in the knowledge of what could be expected. As such, the final topic of this video is about looking back at the past in an attempt to get an understanding what has happened in bear markets. First and foremost, risk assets exhibit expanded volatility while declining, making lower highs and lower lows. As in uptrends, there are countertrend bounces, but those are followed by strong selling pressure. Unlike tops, which are a process and usually take a long time to develop, bottoms can be V-shaped or take the shape of a long, consolidated sideways base before eventually beginning that new uptrend. The challenge of managing falling markets is that some of the biggest, most powerful rallies come during oversold bear markets. It's very hard to tell, and you'll only know after the fact, whether each rally is the bottom or just a dead cat bounce. Taking a look back at the 2008-2009 50% bear market chart, the first thing that you should take notice of is that the S&P index fell more than 53% in 9 months. Remember, a 53% loss requires a 210% return to get back to even. In that 9-month span, there were 5 rallies, some in excess of 20%. Excluding this final rally, which marked the end of the decline and the beginning of the new uptrend, each rally was followed by another decline, the smallest being 15%, while the largest was 36%. If you tried to jump on board the long side, trying to pick the bottom, the market took you to school. Stopping here and thinking back on the first part of the video, how would you or did you feel if you were invested during the 2008 market decline? For those that got out of the market, how did it feel during those 5 rallies? Were you upset you missed out on those opportunities to make a few dollars? It's easier to answer those questions with history as our guide, but most everyone reacts differently under stress, so it's best to have a plan on what to do if or when this were to occur in our future. For those viewers looking for answers, I currently have 2 different plans for client accounts depending upon risk tolerance. Currently, all accounts have the majority, if not all of their assets in fixed income, cash or cash equivalents, awaiting the end of this downtrend. For those with the least risk tolerance, I will be waiting for the long-term model to present a buy signal. Keep in mind, in the 2008 bear market decline, that signal did not come until after the market had already rallied 25% from the bottom. It does not pick the bottom, but instead a low-risk entry after a confirmed change in trend. For those with higher risk tolerance levels, I'll begin to nibble when the technical signals provide a good risk-to-reward ratio. It's always a trade-off between being too early and being wrong, creating the potential for short-term trades, versus getting better returns. As of right now, the charts are telling me we're likely not done with this decline. Reviewing tens of thousands of charts, I can attest to that after a double-digit decline, bottoms are usually formed after prices retested prior lows and momentum has put in a divergent low, neither of which have occurred. It doesn't have to, but there's a high probability it will. As such, this year-end rally is likely nothing more than a dead cat bear market bounce. I still see zero evidence that this is a bottom, and I'll remind everyone that in addition to the requisite price and momentum divergence, bottoms form when sentiment is at a negative extreme. Based upon social media chatter and the Investors Intelligence Sentiment surveys, we have not seen the right level of capitulation to think that this is anything more than just a bounce. As such, it will require patience. I would be more than welcome being wrong and this rally turning into a new bull uptrend, but it needs to prove itself first. Regardless of a bottom or not, going forward, we should expect to see very choppy, highly volatile price swings in order to shake out the remaining sellers and bring in new buyers. This takes time. Since World War II, using an arbitrary 20% decline definition as a bear market, there have been 11 S&P 500 bear markets. 8 of those spanned a loss of between 20 and 40% and lasted 11 months on average. 3 of the strongest bears have experienced declines greater than 40% and lasted 22 months on average. While we've just entered the smallest loss required to meet that bear market definition, we're nowhere near the average time period they have historically lasted, which adds more fuel to the fact that we likely have further to go. I sent out a blog post outlining potential targets for the US stock indexes based upon pattern targets and major support and resistance levels. I'd not put much faith in them because markets that are in impulsive sell-offs ignore everything. The bottom line is selling will end when sentiment and fear have reached their extreme. All else be damned. At that point, the market will again prove the majority wrong by finding the bottom just when the majority have turned bearish. In an attempt to keep a balanced view, the bullish possibility is the fact that historically, after a terrible quarter of performance, stocks have been significantly higher when looking forward 1, 3, and 5 years into the future. For example, the small cap index, IWM, lost 20.2% last quarter, which happens to be the 7th worst return since 1979. This chart is a look at future performance 1, 3, and 5 years later of the 10 worst quarterly small cap index performances. I should point out, every past quarterly drawdown of this magnitude has resulted in positive gains. Most were significantly positive. I don't know what will happen, but I do know that human nature makes it difficult for people to handle the types of losses we've just experienced. It invites overreactions and increased volatility of emotions. It's always possible these losses are a sign of things to come, and things will only get worse from here. But we cannot lose sight of the bigger historical picture. No two market environments are ever exactly the same, so there's no way of telling what will happen next, which is why we have to remain unbiased and open to all possibilities. I also know that the history of the stock market performance shows that the longer you extend your time horizon, the higher the probability you have of seeing gains. This relationship seems especially true after big quarterly drawdowns in stocks. While I do expect a challenging investment environment for at least the first half of 2019, the further we fall, the greater the future investment opportunity, which as investors is our greatest wish. Well, let's call it a wrap. That's it for this month. Happy New Year to everyone, and I look forward to providing help to those who are struggling or don't have the time or interest to capitalize on making money in the markets. As always, appreciate your time and your attention, and hope you found this video informative and helpful. If you have any special requests for the next installments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next quarter, this has been Chuck Gibson from Financial Perspectives with December 2018's Charts on the Move.